All right. Welcome everybody on this video who's watching this video. Welcome to our channel. Welcome to this video. We are Decibel Capital. My name is Ankit. Today we are going to be talking about some a very important topic that recently came into my mind on backtesting and trading picks and fake gurus and how is everything of this, how all these items rigged to really fool you. We'll go through an example of a very hot stock, ITC, a very discussed stock in the market realm. So, my name is Ankit. I am a part of Decibel Capital. We'll go through that in a minute. But let me quickly go over a tweet that I posted a few days ago. So this was supposed to be a sarcastic tweet, really, and it was around how we are presenting. Decibel Capital is presenting a new strategy, which is to be given for free of cost to the clients. And if you click on this image that was attached to it, so it showed the strategy's name is Magic Wand. That's the magic jadoo ki chhadi jise kehte hain, magic wand. So that should have been a very clear indication of there was sarcasm in it. But evidently, what it was showing was how you can use a stock. You have this ITC stock here, and how this strategy can convert the stock into a very good-looking P&L curve, very highly beautiful looking compounding P&L curve can be brought out of it. So this was a post I made to kind of draw attention to the point that how such things, how such promises are made in the market to lure people, to lure gullible newcomers into believing that such things are possible. So in today's video, what I'm going to do is I'm going to talk about what did I do, how did I convert this close to close daily close ITCP time series into a beautiful looking backtest. So do watch this video till the end. You'll be able to see it towards the end of the video. We'll have some background talked about it earlier. So at the back of that, what I did was I actually have created a blog post on the same topic. So we'll cover that blog post. You can actually visit this on our website, which is www.db.capital. And if you go on more and blog here, you'll be able to reach to our blog on which you'll find this post there. So let's talk about what's going on, and let's talk about how do I think about it. So this blog post or this post was made to highlight the point that I just already made. There were subtle hints in this post that this is a sarcasm because I used the word magic wand. I used 50,000 rupees in INR, and I used a catchy popular stock of ITC to draw attention. So these are some of the features you'll find anytime you're watching a video on trading. You'll find somebody saying, do this, do that, and get your money double or make money every day. These kind of hacks and tracks are used by people to lure you to into believing that some kind of magic is existent in the market. And if you follow them, if you subscribe to them, if you pay them money, you'll be able to make such kind of returns in a very short time. Unfortunately, most of it is not true. So I'll talk about that. So I'm just talking about in this blog post, I'm talking about this tweet that I made and the infographic that I used. Like I've already showed you, the close to P&L curve. Uh, and one thing I'd like to say here: when you see something which is too good to be true, when something looks so out of the way positive, it's most likely the reason is that it is too good to be true. There is some hidden message, there is some hidden reasoning that it looks too good to be true. So this applies in life, this applies in our uh, practical lives, in trading, all the way through. So that's the point I'm trying to make here. This chart looks too good to be true, and I was expecting people to read this and tell me that there is some scam here or there is some catch here. While some of the people did do that, some of the people did ask me and question me, and of course I received some of the abuses as well. So people who do not know me, they do not know that I don't subscribe to the school of thought. I'm on the other side of the spectrum who wants people of such kind of shenanigans. But it's not their fault. They're coming to my timeline probably for the first time and noticing this huge promise of 8 times your returns in six years, right? So if you started with 10 lakhs of capital, you suddenly have 80 lakhs capital in 6 years. Who wouldn't want to do that? So people were questioning me, and but uh, to my surprise, I was hoping a lot more people will question me, but that was not the case. A lot of people actually wanted to. They talked about what the strategy could be. They were speculating what is going on, or this is A versus B. Without probably thinking about that this seems to be too good to be true. So anytime in trading when you see something really really good looking, just imagine or believe that it's too good to be true. So, then I further talk about some of these beautiful back tests. So, a lot of times when you see such back tests in which you have these fancy looking graphs, fancy looking PNL curves, as we see, you should know that there are, these back tests have most likely been created um, with a few assumptions or there are few gaps in this back test. So let's talk about that. What are these gaps? So first gap is usually that this is usually over optimized. So what I mean by that is you see this curve, you see this 6 years period, you see this PNL curve, and what has happened essentially is somebody has used the features of the data and picked up just the right sort of parameters which will give you the exactly the output you want. So in data analysis and data science, if you follow, you'd often hear a saying which says you torture the data long enough and it'll tell you what you want to hear. So that's the trick with data. You can cut, slice, dice, and manipulate it in certain way to tell the story that you want it to tell. Whereas your real data analysis that you should do for trading should be completely unbiased. You should be challenging what my backtest and data is telling me. But that's for some another day. That discussion is for another day. So what I'm saying here is that these parameters in a lot of backtests are over optimized. So if you see somebody using a moving average period of 19 versus 31 and saying this is the best combination of moving averages, trust me on that, that's not true. Moving averages, if they are predictive, for an example, or if they are able to forecast when the money can be made, then your combination of parameters around that selection should not matter much. So what I mean by that is if you change 19 cross 31 to 20 to 30, 20 cross 35 or 15 cross 20, it should still give you some results, some positive results. But usually that's not the case. You will go to a scenario, a seminar or webinar or somebody talking to you and say, oh, this is the best. And I often get these questions. What's the best way? What are the best possible indicators and combinations of indicators that we can use? Just keep in mind that's overly optimized, overly backfed. And another example is this option selling, intraday defined, risk defined strategies or straddle selling. You'll find people selling at a 920 and 923 and 928 and 919, all these input times, and exiting at 2:56 p.m. instead of 3:10 p.m. and saying we exit the market early than everybody else is exiting and that's really our edge. No, that's not the edge. That just means you looked at the data which is in front of you and you found which is the best combination of my selected parameters which will give me the best result. But unfortunately, live trading is not that. Once you take your backtested system to live trading, there's new data which is going to come in, and it's not going to comply or conform to the historical data that you already have. So until unless you have found a way to find an inefficiency in the market, you are essentially not trading. You're just gambling or speculating. So that's the first assumption or first caveat or first gap in the beautiful backtest. The second one is that it will not make a lot of time these backtests will not make any realistic assumptions. So while everybody knows that there are commissions and taxes that you need to pay when you trade, there are other so many hidden costs that people don't talk about or don't want to capture in. And one of them is the simplest slippage. So what I mean by slippage is you in your backtest it shows that at 5 minute closing candle your price is let's say 100 rupees, and you say, okay, I'll be able to buy at 100 rupees, and then you square it off whenever you square it off. But in reality, when it goes to trade, you will never ever, or most likely ever, be able to buy at 100 rupees until unless you have a very sophisticated execution algo in it. If you go and trade on market orders, or even if you try and limit orders, you will rarely get a fill, or you'll rarely be able to get in at 100 rupees. You'll probably get 100 rupees and 20 paisa, 30, 50 paisa, 1 rupees, whatever might be the case. And that's really slippage on top of your brokerage and taxes that you're paying. So a lot of time these backtests are not taking into account these slippages. And more importantly, which is something which never gets talked, is how there are some unrealistic assumptions in the back test. So you will see a close candle, daily close candle, and say, okay, on a daily close candle I will buy. But then daily close price, if you do not know, is not the last traded price of the market. So what I mean by that is, at 3:30 p.m. in Indian time, market closes. The close, that's the last traded price. The 3:30 p.m. trade is the last traded price on the market. But the closing price is an average auction price, volume weighted average auction price of last 30 minutes of the activity in the exchange. And that's how they're arriving at close price. And you will be able to see, if you Google this, the distinction between close and last traded price. These are two different prices. So your back test is taking into account close prices on which you will ever never be able to trade. And if it shows positive results, then you are essentially fooling yourself and not anybody else. Or if somebody is trying to fool you by providing you with that. And lastly, something which is never talked about in systematic trading, and which is inherent in the quantitative trading and analysis that we do, or we at least try to practice, is importance of in sample and out sample of data. So what do I mean by that is, you have your whole data set in front of you, whatever historical data you have, and you're trying to find a strategy. What you should first do is divide that data into two sections, maybe 70-30, 60-30, 60-40 ratio. Um, and use one section as your training data, on which you will look for effects, and you will create your rules, optimize them. That's okay. And once you're satisfied with that optimization, you go and test it out on your out of sample data. And once you do that, you whatever the results are out of sample, you take it as it is. If they are good, you take the strategy live. If they are not good, you just trash the strategy. You don't take that out of sample outcomes and then go back and tweak your results, because then you are not really using out of sample. Your unseen data is now a part of your backtest. And people don't understand it. One of these other simplest reason, if you have less data, simplest way if you have less data, is to have your back tested strategy do a walk forward testing. So what I mean by that is, you, let's say, back tested until yesterday, and then from tomorrow you start a paper trading on that strategy for 6 months. You plan, you will not put your money into it for next 6 months, 8 months, depending on what your comfort levels are. And only once you are comfortable, once it performs well enough in unseen data, then only you take it live. So a lot of these backtests, they'll take the entire data into their own into their backtesting framework, and they fit, or as I earlier said, curve fit to that data, and bring up with a very beautiful backtest. So backtests are there to fool you, and one example I showed you will probably be that, or may not be that. But wait for that. Then what I talk about on this blog post is this sure shot trading tips, and fake or inexperienced guru. So a lot of times you see people making out calls to buy XYZ stock with target 1, 2, 3 for next week, and then as soon as that the stock starts moving, they will start yelling target met, target met, target met. But what they are not doing is, so for example, they give you 10 picks, they'll come up with 10 stocks to buy, and then as soon as they at the end of the say, they say, oh, three targets hit, four, they will not even say three or four, they will say target hit, target hit, target hit. But they will not talk about those that do not hit the target. So if you think about it, if even if it's a coin toss probability, if you flip a coin, if it heads you buy, if it's a tail you sell, you do that on 5-10 stocks, then half of them will be right and half of them will be wrong. So by default, by not doing any analysis, you have 50% probability of getting your trade right. But then if somebody is giving you calls, and he or she is only talking about 30-40% trades who are winning, then they're actually doing a worse job than a simple coin flip. So that's what you should think about when somebody gives trading calls, that how many trading calls are they giving, and if they are following up on the losers, and how. The other important aspect of this is, which I've tried to list here is, let's say they give a buying call to buy a stock at 100 rupees, and then with the target one of 104, target two of 108, and target three of 115. So essentially, what they are saying is you can buy at 100 rupees, and they have these three targets. Now, what will happen is the stock will not go up or down in a straight line. It will go up, down, up, down, up, down, kind of a pattern. So what happens usually is, let's say when it meets a target one, they'll say, "Oh, our first target is met." Now, you as a trader or investor do not know what you want to do at 104. Should you hold or should you get out? Now, let's assume you decided to get out at 104 and market went all the way to 108. Now, what will happen is this trading call provider will say, "Oh, our target two is met, so we have made 8 rupees on 100 rupees, so 8% return." Whereas in reality, you have exited at 104. But it's because they say, "Oh, because it went to target two, it's your fault you exited early." Okay, nobody knew at 104 whether the stock is going to 108 or not. But let's take another example. Let's say it came to 104 and you decided to stay because you thought it's going to go to 108. And now market reverses and goes to 109 or 99, and then you exit at 99, you book a small loss of 1 rupee. But since it was target was made at 104, they say, "Oh, first target met," and our target, we made 4 rupees. But that's not how real trading will take place. In reality, when it reaches 104, nobody knows whether you should book or not. So all these examples with two, three targets are all usually bullshit. You have to be very careful of who's giving them, if they're trading them or not. And a lot of time, these people who are giving these targets are not even trading them, or even if they are trading them, they will not tell you what their actual result was. They might just buy at 100 and get out at 102 just to tell you, "Oh, we trade our live calls," but they are not trading what they are preaching. So be careful with that, right? And last are these some fake or inexperienced gurus. So if you think about it, what it takes to become a guru, you need some followers, you need people to start giving calls, and you start getting a lot of followers because there's inherent greed in the market for people to seek seek the easy way out, seek how easily we can become overnight millionaires. But that's not reality. So it's easy for anybody to become a guru or a trainer and start training you without even having any experience. It takes 6 months or 5 months, even 3 months, for somebody to start giving out calls or start giving trainers, whereas these people are either inexperienced, they've just started coming up in the market. So if you look at the 2020 year, when markets were so volatile and almost everybody made money when the market started recovering, you would have seen a lot of mushrooming of such kind of people who just started 6 months back and now suddenly are the most promising traders out there. They do not have a history. I'm not saying that they are not valid traders, but a lot of them are not. Some of them might be genuine. Some of them are actually trying to trade and trying to see and trying to share, but not all of them. On the other hand, there are a lot of people who've been trading for a while, and at times they are actually genuine traders and genuine trainers who would at least teach you some basics of the market, if not the whole voodoo science behind it. But a lot of times, a lot of people who've been training and trading for a lot of times are just fooling you, just to make you believe with this kind of randomness in their forecast or their strategies and system. They can always pick the best combinations of outcome, just like our back tests with a training seminar or a training setup. They can talk about it. They can say, "Oh, our targets are met and this was that," and just to make you believe that there's the best way out to make money while you lack something. So be careful. Seek a genuine teacher who can teach you. Ask questions about their methods, strategies, their performances before you subscribe to them, if you ever do that. So, this is a bit of background, and on the back test or the sure shot trading calls, or these inexperienced or fake gurus who propagate themselves to be the masters of a lot of things. Okay, so with that said, let me now talk about how did I create this beautiful looking back test. So let's look at it earlier again. So this is a back test or P&L result. So it shows how didn't load up, sorry. Yeah, it shows how an ITC stock can be changed, or the performance can be changed from a range bound stock. So think about it. What am I saying here? I'm saying you take this range bound stock which hasn't gone anywhere for 5 6 years, and now I'm going to teach you a way to make it 8 times your money. So here's a caveat for you. I'm going to tell you something very unique about the markets next. Whether it is reliable or how reliable it is, you'll have to investigate. There's no easy money in the market. Nothing comes for free, without the hard work at least, right? So let me tell you what did I do, and how was my hypothesis, or where did I start from? Okay, so I talk about it here and again on my blog post. So, um, back in March, I had talked about that. My hypothesis is that a lot of trading returns from any stock comes from overnight trading. So, what I mean by that is, if you split your excuse me, if you split your returns into overnight returns, which is close of today's market time price and open of next day, and that's your overnight return, how much stock has moved as of close of today to next open. And then intraday is the same day. So intraday is what's the return of your stock from today's open to today's close. Those are intraday returns. So my hypothesis has been, if you split these two returns, you will see that real returns of a trading asset or a stock are made to compensate for the risk holding an asset overnight. So what do I mean by that? When you're holding an asset, a stock overnight, you're holding it, you're carrying the risk. And that's why a lot of traders do not want to take that risk, because they do not know the unforeseen events that can happen overnight, which can completely kill the stock or completely change the dynamics. So there's a lot of risk, and that's why people don't want to hold it. That's why people want to trade intraday and enter and exit out of the markets intraday. But guess what? Intraday returns, the overall stock returns of any stock are driven by overnight returns, and I'm going to prove to you that in few minutes. So that was my hypothesis, that I thought, or at least I believe, based on my market understanding and based on some of the research that I've read in the past, that stock market returns are completely and mostly carried over from the overnight returns. So with that, I set out to test this effect in Indian stock markets, and I created a code. So I code in Python. This is a very small example of the code I did. So what we are trying to do here is we're trying to plot the daily closing of the ITC stock. So for anybody who doesn't understand Python, let me explain. Somebody who understands Python, this will be pretty straightforward. But if you don't, so we are importing some libraries. So what do I mean by that? Think of these are packages or some important inputs that we need to be able to run our code. Then file path is where my data is stored. So this is the ITC data on daily closing basis. And then I put some command on how to read the data, how to format the dates, and then go ahead and plot the closing price. So you'll see I have the 5 year, about 5.5 years of data of closing price. And if you look at any charting software, Trading View or Yahoo Finance or any other Go charting, whatever might be the case, you'll see it will perfectly resemble what the market has been doing for ITC. What I did then was I coded to separate out the intraday and overnight returns. So that's what we are doing here. So as it's written here, your intraday returns are simply the return from the open price of a day to closing price of the same day. So if your market opened at 100 rupees and it closed at 110, then you have 10% return for that stock in that day. That's the intraday return. And then overnight returns is open price of today with respect to the closing price of yesterday. So in a similar example, let's say market opened at 100 and closed at 110. That's intraday return of 10%. Now at 110, the market opened closed at 110 yesterday, and now it's opening up at 105. So that's roughly about 4.5% of negative 4.5% return, or 4.6% return negative on an overnight basis. So that's how you're calculating these ID rate, which is the intraday return, and then overnight returns is the overnight returns. overnight returns, right? And then I there was some plotting formatting I did. I didn't want to put the code here, there was no reason, but then I just plotted this intraday return and overnight return here. So if you see this return, you'll see the overnight return is in this orange yellow line, and intraday return is this blue line, and below is the close chart. So you see this is for the same stock, for the same price series of closing data. You are able to see that intraday returns are almost flat in the chart, whereas your overnight returns have gone exponentially higher. So all of the returns from the ITC stock in the last 6 years has been driven by overnight returns. So what is the simplest way of saying you can make money? You buy your today's close and sell it on tomorrow open is the simplest form of the system. Let me tell you though, this has a lot of gaps. This system is not a foolproof system. It needs a lot more robustness testing, but that's how a system is created. But at least now the system has an underlying effect. That system you're trying to create has this effect in it. By the way, let me tell you, you'll not be able to buy at the close of today, and that's what I was explaining earlier in the video. So you can go back and check that your closing price is not the last traded price. You can think about it both ways or Google about it. There's a difference between closing price and last traded price. So you'll not be able to trade this, but this is an inherent effect into it. And what I did next was I just created a new chart for overnight returns. So there you go, voila. You have this overnight return looking chart, which is the same time series, same effect that I did. And it looks so beautiful. It got multiplied. These are log returns. So on product price. So this is one, it goes 8 times in 6 years. Who wouldn't want to do that? And that's how I created that Twitter post. So if I pull that up quickly, you'll see these are the charts, right? There you go. This is my overnight returns chart, and this is my close price chart. So this is how I created a very simple back test, a very simple effect, which is not even tradable, which has no brokerage involved. It has no slippage involved in it, but it looks so beautiful, and everybody wants to know. And I create these magic words like magic wand and whatnot, and everybody is interested in reading about it. So if I were to scam you, I would say, oh, I can teach you the strategy. You pay me 10, 20, 20, 30,000 rupees, whatever. And when you come in and join me, I will teach you something very, very basic in the market, which is most likely not even replicable. So, and the reason people are able to do that is a lot of new traders, a lot of starters in the market are looking for quick shortcuts. They want to buy their next Mercedes in 3 months, or buy a new house, or want to send their kids to a very modern upscale school and whatnot. Everybody has their own life dreams, and stock markets is seen as a quick way out for them to exit or to make those dreams come true. And that's why these kind of things sell in the market. But you, whosoever is watching this video, are now at least slightly more informed in what to look at, and how can these be challenges, right? So if there's only one thing that couple of things that I would like you to learn from this is: a, trading in markets is not easy. Making money is further difficult. Trading itself is difficult, let alone profitable and not profitable. But making money is further difficult. So if somebody is promising you an easy path out or a magic wand, for the lack of a better word, just turn around and run away, because most likely you'll get scammed or fooled into it. And if you are ready to work, if you're ready to put some hard work behind any of these market phenomenons, then this is an effect I'm just showing you. This is, nobody has talked about it. I mean, I shouldn't say nobody. People have talked about it, but it's not common knowledge. Your returns of a stock are driven by overnight returns. So how do you trade that? How do you build a system around that? It's a whole lot research driven process that you can do. But I hope that gives you some scope, thoughts, for thought, food for thought. And I hope you are able to find some merit and benefit from this video. That was more likely it. So I'm going to stop. I hope you have a good evening or good night, good morning, wherever you are. and hope to see you around. You can check out our website dv.capital on which you'll be able to see this blog post and all the details with it that I covered in the video under the blog that I just showed in the starting point. All right, thank you very much. Bye.